Video, I'm going to be going over an advanced tax strategy that we utilize for our clients. Now, what I want to do, or let me give you a little bit of background about myself, right? So my name is Kevin Andrade, the CPA, tax strategist, tax advisor. I've been in the accounting industry for over 10 years. I own my own practice, my own tax advisory firm based out of Frederick, Maryland. And we're on track to pretty much save our clients over $1 million this year. And that's just going to continue to grow as the firm grows and as we continue to serve and provide value to our clients. So that's ideally who I am and what we're trying to accomplish. In this video, I want to go over a specific tax strategy. So, you guys always hear tax strategies out on social media, and then some of it, they don't cover all the details. And then some of the content, is either inaccurate or just go over basic fundamental strategies. Invest in your 401k. How many times have you gotten that advice? Or just if you're a business owner, go buy more stuff, right? And then just get a tax deduction. That's not optimal tax planning advice, in my opinion. So my goal is to really just educate those who are watching from all aspects, right? From clients, from W-2 owners to business owners, and all the likes in between. I just really want you to succeed. And with that said, let me jump right into this strategy that I'm going to talk about today. Now, I have my notes here on the side, so I'm going to be looking on the side of my other screen. So just want to make sure I capture all the details, right? At least everything that needs to be said on this video. So I want to talk about investments, specifically oil and gas. So oil and gas is one of those advanced tax strategies that I personally love. And so in our firm, we have over 65 tax strategies, and we're consistently adding new ones every single month. Right now, we're in the vetting process of adding 4 to 5 new strategies to our consistent library of strategies. And now it's never a one size fits all. People always say, hey, can you tell me what strategies for me? And we don't work that way, but we'll get to that at the end. Right now, I want to answer or go over oil and gas. It's an investment tax strategy. I call it the double-edged sword in a good way, because on one end of it, it has this wealth building component. It's return on investment. It's an investment, right? Similar to how you invest in stocks or cryptocurrencies, real estate, whatever the case may be. Oil and gas is also an investment. So there's a wealth perspective from a return on investment, right? And then you have the other side of the sword from tax benefits. So I love this strategy from that perspective. You get tax savings along the way while you're accumulating your wealth. It's a fantastic strategy to just diversify your portfolio. And it's really minimal activity, which my clients who are very, very busy business owners and high income earners, the less time they have to spend in a strategy, the better, because that means they have more time back to produce the income that they want to produce, to do what they need to do, go on their vacation. And so if you don't have to do the least amount of minimal effort to get a big bang for your buck, I love that strategy. So what I'm going to do now is go ahead and share my screen, and I'm going to share my iPad, and we can kind of walk this through. So let's see if it works. All right. So oil and gas, it's pretty much an investment, right? As I mentioned before. And what's happening is we partner with various, strategic partners that we have. And one of them is a strategic partner in this space. And so what they do is they already have these locations across the US where they have identified, oil essentially. So there's definitely a component to exploratory, and please don't mind my spelling. I'm an accountant, okay? I'm not, yeah. So there's exploratory, and then there's really like pretty much identified oil and gas. Exploratory is more of like, let's drill in this area and try to find where there's oil. And from an investment perspective, you're kind of just gambling because you don't know if there's going to be oil, how much money you're going to put into it. And it just seems very inefficient versus this other scenario, which is the partner that we work with. They've already identified the the hotspots of oil, right? Of where it exists. And so what they do is they partner with investors, right? This investors work in a fund. So let's just use an example like Joe Smith. He wants to invest in oil, so it goes into this fund. So they build up this fund, right, that they open up every single year. And so the subsequent year, so on January 1st, or usually like the first quarter of the year, that's when they go and start this the oil and gas process, right? They go take the machinery, they drill to the dirt, and then they start getting oil. And then what happens is you get a payout and a dividend process. Okay. So before I actually go into the investment component of it, so this is oil and gas. This is at a high level how it works. You get paid, and then you receive tax benefits in year one, and then pretty much years 2 and beyond, you get paid a little dividend every single quarter. That's in a nutshell how the strategy works. Now, let's go a little bit deeper. So I mentioned very quickly tax benefits, right? Which is my favorite part. I'm a tax advisor overall. And so many folks go from 50 to 80% that they're able to deduct of whatever their investment is in year one. And how are they able to accomplish this? There's something called it's IDC, intangible drilling costs. And we utilize intangible drilling costs to pretty much get a depletion allowance, okay? So we have depletion that's being done on, like, for example, the machinery, all the equipment, like everything to set it up, right, to get that process going to drilling for oil. So in that process, we are able to deplete or get a good amount of a tax deduction in year one. Similar to real estate uses depreciation. Well, for oil and gas, it's depletion. Similar, very similar types of deductions, okay? Now, where this is 50 to 80% come into play. So let's use an example of $100,000. If you invest $100,000 into oil and gas, most oil and gas firms out there can do 50 to 80%, right, of a deduction. The strategic partner that we work with is in the 80% realm, okay, which is fantastic. That means if you invest in year one $180,000, or sorry, $100,000, you're going to get a tax deduction, okay, of 80,000. So it's 80%. So that means this is going to reduce your taxable income. So if you're in the 30% tax bracket, if we do some math, let's do 30% times $80,000, you're going to be saving $24,000 in taxes year one. Fantastic. Love it. So that's how it works in a nutshell, okay? Again, using the example of $100,000, get 80% of a deduction year one, 30% tax bracket, because remember, a deduction is not a dollar for a dollar reduction of your taxable income, of your tax liability. Remember, we always have deductions versus credits. Deductions reduces your taxable income, while a tax credit, reduces your tax liability. Taxable income. I told you not to pay attention to my handwriting. So deduction is the oil and gas scenario. Just switch colors just to keep it nice and light and fun. So in the scenario where you invest $100,000, you get a deduction of 80,000, reduces your taxable income. Assuming you're in the 30%, you're saving $24,000 in year one. Okay. And then what happens is, because of depletion in the IDC, it generates a loss that appears on your Schedule E as an active business loss, which is great. And how does it become an active business loss? Is because in year one, you are a GP within the fund. Remember, we have this fund that you're invested in. Okay. There's money in your investment, and you're in this fund now. So in year one, you're a general partner. Okay. And the whole purpose of you becoming a general partner in year one is to unlock tax losses, right? from this depletion that's occurring up here. And then what happens is in year 2, you are then switched from a GP to an LP, which means you're switched from a general partner to a limited partner. Okay? And then your income now becomes passive. And passive income is taxed at a lower rate, usually from ordinary income, which is great. Perfect. And then remember again, in year 2, you're going to get paid an ROI, a dividend, pretty much for the next, until all the oil is extracted. I spoke to someone, another advisor, who his client, when apparently they were having an introductory call, and the client told him that, yeah, I've invested in oil and gas before. I'm still getting paid dividends. She said she gets a couple $1,000s a year for not really doing anything, that they just have so much oil that they just keep extracting. And I think she was on year 12 or year 13. Insane, right? She made her money back within, like, I think she said 4 to 5 years. And then everything after that's gravy. So it's a powerful strategy for both, again, tax benefits and wealth building. Now, going back to this diagram, year 2, you get flipped from GP to LP, general partner to limited partner, and then you're getting an ROI dividend getting paid out on a quarterly basis. Okay. Question that I get asked, or that's a commonly asked, well, what's the payout, right? So ROI. So the first, like, year 2 through year 4 or 5, the average ROI is between 18 to 20% off your initial investment. So from years 2 through year 5, you're going to get paid between 18 to 20% of your initial investment. So going back to the example of $100,000, it's not based off this 80. The 80 was the tax deduction, something completely separate. Okay, emphasize that. So the $100,000 is going to be your initial investment, right? To the fund that we talked about. In years 2 through 5, you're going to get 18 to 20%. That's 18 to 20K. Okay, that's fantastic ROI. Can you do better in crypto? Sure, I guess. You double your money, but why the risk? This is more of a very consistent strategy that's been around for several decades now at this point. Let's see. Let me go back to my. So yeah, most investors see a return on capital between 3 to 5 years, and then after that, everything's gravy, right? And so tax benefits again, and wealth building. So taxes, check. Wealth building, check. Love it, love it. Now, I want to talk about, now that we've gone over the strategy, I want to talk about what type of income this strategy can offset. Because that's the number 1 question, right? Well, one of them is W-2 income, which is great because there's not many strategies out there that they're more advanced that can really pack a punch to W-2 income. So that's what I love about this advanced strategy, is that oil and gas is one of those that powerful strategy that can reduce W-2 income. Okay. Another one that it can reduce is business income, of course. So all my business owners out there, if you're a sole proprietor, LLC, S corp, reducing business income, it's absolutely something that you could do. This strategy also reduces any RMDs, which stands for required minimum distributions. So those are my folks that are over 70. Capital gain. If you sold stocks, crypto, high amounts, you need another strategy. This can absolutely offset it. Net investment tax, NIIT. This is for those that have a lot of brokerage activity, dividends, interest income, brokerage, capital gain. Net investment income tax is something that's it's like a phantom tax. You don't feel it until you file your tax return. It's like 3.8% above your. There's a calculation to it, but if you're earning more than $250,000, you get hit with this net investment tax based off your investment activity, which sucks. So the fact that this can help reduce that is absolutely amazing. It's just an added bonus on already a powerful strategy. So these are the types of income you can offset. Okay, income offset. Cool. Now we went over the strategy, went over the tax benefits, we went over the ROI perspective, and what types of income it can offset. Now, who is this for is very important. Now, it can offset this types of income, but this strategy is very particular on who is it for. So you have to be, one of the qualifications for the strategy is that you have to be an accredited investor. Accredited, I guess not really an acronym, accredited investor. And for those that are not familiar on who or what are the requirements for an accredited investor, I can't even say the word, is going to be a couple things. So number one is determined off income or your net worth. And 90% of the time, people will look at income to determine how to qualify for an accredited investor. And so if you're single, you have to have made or be making $200,000 of annual income for the last 2 years. So it needs to be consistent. This is gross revenue, gross income. So it's $200,000, that's the minimum. And if you're married, the amount goes up to $300,000. What does this mean? That means your income needs to be at least $200,000 for the last 2 years if you're single, or $300,000 if you're married for the last 2 years. So that's just to get the accredited investor status, right? So this is option one, which is going to be 90% of you folks. Because the net worth one is much more difficult to attain. And if you have the net worth of this requirement, you're most likely already qualified from the income perspective. So the net worth, just a definition of the accredited investor. If you have $1 million of net worth, excluding, keyword, your primary residence. Sucks. Because a lot of our equity, especially with the pandemic, we have a lot of built-in equity in our primary residence, but that's just a calculation of how they calculate your net worth. They exclude your primary residence, specifically for the accredited investor strategy or status. And what is net worth? Is pretty much your assets minus your liabilities. Okay, the cash you have, money markets, capital accounts, investments, real estate, excluding your primary residence, and then liabilities is like your credit cards, any loans, mortgage. You should subtract that to calculate what your net worth is. Okay, but 9 out of 10 times we're going to be looking at these income. Okay, so that's the accredited investor. So you need to qualify your accredited investor. And then the next thing I wanted to mention is the investment amount. Now, most of the big boys require a minimum investment. So the minimum investment with our partner is actually $50K. Most other folks are actually at $100,000 that they have to that's their bare minimum, or they won't even consider you to be a serious investor. But with our partner, we're able to get it down to $50,000, a lower barrier of entry, still good amount to invest. That's why I recommend the strategy only to folks that it makes sense to. This is not for everyone. Now, if you do have the extra capital to invest, this is a fantastic strategy. Again, we have those tax benefits, we have the wealth component of it. You have your tax savings, you have your ROI, 18 to 20% year 3, years 2 through 5. Oh, another question may ask, what happens after year 5? You still get a return on investment. It's just going to decrease from like 13 to 15, 10 to 12, 8 to 12, right? As the less and less oil gets extracted, because the bulk of it happens usually between like years 2 and 5 of all the oil that's being extracted. So that is the oil and gas. That's pretty much the oil and gas. And I love the strategy. The strategy is fantastic. Just double checking my notes. And yeah, that is oil and gas wrapped up in a nutshell. Now, if you're interested in learning more about tax strategies, or if you want to be more proactive, this is one strategy again in our tool belt of 65, and we're consistently adding more and more every month. If this is something you're seriously interested in, like you're looking for someone, a tax advisor who's more proactive and trying to save you in taxes, feel free to book a call with us. Happy to walk through, have that conversation. And spoiler alert, I'm not going to go over tax advice in our first call, but I want to see if we can help you and I can explain how we can do that. That's usually from our tax assessment, okay? And I can go walk you through in detail at a high level tax assessment is identifying tax strategies through a deep process that we've constructed and built that clients have loved, and we've saved time and time again, a good amount of close to $1 million in tax savings for 2025, and we're consistently growing. And so I would love to have that conversation if that's something you're interested. If not, just enjoy the content. Feel free to subscribe, as I'm going to keep going over strategies from the course of this YouTube journey. So with that said, thank you so much, and hope you have a great day.